What is money? Everybody wants it. You need it in a society. But what is it? Well, money is anything that serves as a medium of exchange, a unit of account, and a store of value. Great. Now, what does any of that mean? Money as a medium of exchange. A medium of exchange is anything that is used to determine value during the exchange of goods and services within an economy. If you go to a store and you want to buy a shirt, you and the seller know how much the shirt costs because of the value assigned to it using money. If we didn't have money, we'd have to use a barter system in which people exchange goods for one another. It would be rather difficult to determine how much of whatever good you're offering would equal that shirt. So instead, money makes life easier. Money is a unit of account. A unit of account is a means of comparing the values of goods and services. If you go to the store to buy that same shirt and you find that it costs $30, and you understand that at a previous store that you visited it was $25, you understand that in one case it is more expensive than the other. Some things cost more than others. They have a greater value assigned to them. They only have a greater value because money is serving in that function. And money as a store of value. If you have a $10 bill in your pocket and you decide to go to the store and spend it, you have spent $10. But if you don't do anything with it, if you continue to hold it in your wallet for a period of time, it will still be worth $10. So money as a store of value is something that keeps its value if it's stored rather than used. Of course, the exception to this is if a person were to hold on to money and then an economy were to experience a period of inflation, in which case the money might actually be worth less in the long run. Any item that is used as money must have 6 characteristics. And when we're talking about money, what we're really talking about is currency, the coins and paper bills used as money in a society. And throughout history, lots of different objects have been used as currency. But in order to be an effective currency, it must assuredly have these 6 characteristics. Durability. It must withstand physical wear and tear. What do you do with money? Well, when we're talking about currency, you carry it around, you hand it to other people, you exchange it. It cannot simply fall apart. It cannot be fragile. This is one reason why metal coins have been used so much throughout history, because they can withstand wear and tear. Portability. You have to be able to take it with you. Throughout history, there have been examples of people using very large stones or even livestock as money. Well, one of the downsides of that is you can't exactly take a giant stone with you to the marketplace. If you're using livestock, a cow might not want to go where you want to go. So having something that you can easily carry with you is an important characteristic of money. Divisibility. In order to be useful, money must be easily divided into smaller units or denominations. For example, if something costs $8.75 and I pay with a $10 bill, I'm going to get change in the form of probably a dollar bill and some change. Money must be able to be broken down into smaller units in order to be effective. This is another downside of using something like livestock for currency. You can't easily break it down into smaller units. Uniformity. Any 2 units of money must be uniform. That is the same in terms of what they will buy. $1 or 4 quarters, they're all worth $1, and they're worth $1 in all contexts throughout an economy. Limited supply. Money must be available only in limited quantities. A society could decide to use anything as money. They could use grass as money if they wanted to. But that's something that's in tremendous abundance. If individuals can easily acquire an unlimited amount, then it doesn't really have much value. So anything used as money must be in limited quantities. And finally, acceptability. I suppose this might be the most important thing. Money has value only if buyers and sellers, workers, are willing to accept it. If no merchant will sell you a good for what you're offering, if no worker will accept it as payment for their labor, then it's not a very effective item to be used as money. So that's what money is, and those are the characteristics of currency. But why does it have value? Where does the value come from? And throughout history, we can find different examples of money getting its value from different places. Commodity money. Commodity money consists of objects that have value in and of themselves. Representative money has value because the holder can exchange it for something else of value. And fiat money. Fiat money, also called legal tender, has value because the government decreed that it is an acceptable means of paying debts. Are there examples of these three? Well, for commodity money, we could talk about something like grain. Throughout history, grain, which obviously has value because people can eat it, could be used to exchange between buyers and sellers because of what it can be used for. It is a commodity. Throughout much of American history, we use representative money. If you had paper currency, what you had was a banknote that could be taken in exchange for gold, or at one point for silver as well. It was the gold and the silver that had the value, and the currency that people were carrying around was backed up by that and could be exchanged for it. Today we don't use that. Instead, the reason why a dollar bill has value is because the government says so. It says it right there on the piece of currency that this can be used to pay all debts, public and private. Now, if the United States of America says that a piece of paper has value, then that carries a lot of weight. You can quite literally take that to the bank. But the United States government is big and powerful, and it has it has the ability to do that. Not every government throughout history can simply declare that something has value and society would be willing to accept it. For example, during the Civil War, the Confederate States of America began printing up currency. There you see a $20 Confederate dollar. The Confederate government said, this is worth $20, but a lot of people, even in the South, said, I'm not so sure about this. If the United States government says something has value, we trust that. We don't necessarily trust it if a government that was created overnight simply begins printing up paper and assigning value to it. So that's what money is, those are the characteristics, and that's where it gets its value. But how much is there? Well, it really depends on what kind of money you're asking about. So the money supply can consist of two different calculations. Number one is M1 money. M1 consists of all assets that have liquidity, or the ability to be used as or easily converted into cash. What does that mean? Well, it's the money you can use quickly, in other words. So M1 consists of all currency that is in an economy, all the dollar bills, all the coins, all the traveler's checks, although I'm not really sure they exist any longer, and demand deposits, which is to say all the money that is in checking accounts in all the banks in the economy. The sort of thing that you can use a check or, more likely, a debit card to quickly pay for something. We add all that up, we get M1. But that's not all the money that's out there. There's also M2. M2 consists of all the assets in M1 plus deposits and savings accounts, money market mutual funds, and other things that cannot easily be converted into cash. So whether we're talking about a mutual fund or a savings account at a bank that you don't have a debit card access to, things that take a little bit of time before they can be turned into cash would be M2. You add these together, this is the money supply in all the money that is available in the United States economy. So that's enough about money. Let's talk about where we put it, in the bank. Let's take a look at what banks do within an economy. They store money. Lots of folks, if they're smart, put their money in a bank to keep it safe and secure. Your money's a lot safer in a bank than it is in your sock drawer. Banks issue credit cards. Cards entitling the holder to buy goods and services based on the holder's promise to pay. It's a debt instrument that banks are going to issue. Saving money. There's basically 4 kinds of places within a bank that a person might save their money. A simple savings account, a checking account, that is liquid, a money market account, which is a special kind of savings that has a higher interest rate and may have check writing privileges, and certificates of deposit, which are special small savings accounts where a person will put money in for a specified period of time and receive a specified interest rate in return. Loans. Now, this is how banks make their money. By making loans, banks help new businesses get started. They help established businesses grow. But banks also make auto loans and home equity loans and lots of other kinds of loans. Probably the one that most people are familiar with are mortgages. A mortgage is a specific type of loan that is used to purchase real estate. When a person wants to buy a house, they go to a bank and they get approved for a loan, a special loan known as a mortgage that generally has a set period of repayment of 30 years, maybe 15, and a specified interest rate that they lock in. So if that's what banks do, how do they make any money? How do they make a profit? They're not doing this for free. Well, the largest source of income for a bank is the interest they receive from customers who have taken out loans. What is interest? Well, interest is the price paid for the use of borrowed money. So let's take a look at this picture. People put money in the bank. Some of those are deposits from customers when you go and deposit money in the bank. Some of the other money that comes into the bank is the interest that people have to pay to the bank because they have taken out a loan. And then, of course, there are fees and services. There might be a fee on the ATM. There may be a fee for filing a particular piece of paper. The bank takes that money and they retain a required reserve. They don't actually take all the money that comes in and just put it in a big safe in the back. What do they do with the rest? Well, they pay some of it to customers. If you put money in a savings account, the bank will pay you a really tiny amount of interest as a thank you for using their bank. And of course, there are people who walk in and withdraw money, so they have to have some on hand to do that. They take more of the money and they loan it out to other borrowers. Business loans, mortgages, all those sort of loans, the money generated to make those comes from the money that's put into the bank. And of course, they also have to pay salaries and all the other sort of things that any other business does. But the main source of income for the bank is the interest paid to them by people who have taken out loans. So that's money, that's banking. This is exciting stuff.